Hey Big Bulls, in today's edition of Bullseye, we'll talk about three big stories. Raymond's demerger, Tata Steel's big profit and bigger bet, and if India is now a global fund manager's favorite destination. Let's get started. Raymond's share price tanked 65% on Wednesday, dropping from over 1,500 per share to 500 apiece. But this wasn't because everyone was panic selling the stock. It happened because the stock was adjusted on paper after the company spun off its real estate arm. It was in 2024 when the company's board gave the thumbs up to split both its lifestyle and realty business. It's all part of the parent company's bigger plan to streamline its operations and focus on each business more clearly, while the OG Raymond Limited focuses solely on the engineering division. So the lifestyle side went solo in June 2024 and made its debut on the market in September. And for the realty business, it officially demerged on 1st May 2025 after the NCLT gave the green light to the move. Now, since Raymond Realty is no longer under Raymond Limited's roof, the share price was trimmed to match what's actually left in the main business. For investors, they are not losing any value because for every share of Raymond an investor has, they'll get one share of Raymond Realty once it gets listed. It's a straight one-to-one swap. Now, a bit about the realty business. It's really made a name for itself in the Mumbai metropolitan region, or what's known as MMR, and is gearing up for its next phase with a net cash surplus of 399 crores. In the March quarter, the company reported a revenue of 766 crores, showing a 13% year-on-year growth. They're also ramping up their operations by striking more joint development agreements in the MMR region, which is a high-potential market for real estate. So what's next? Now that the demergers wrapped up and Raymond Realty is to list by September of FY26, there'll soon be three Raymond Group stocks: Raymond Limited, Raymond Lifestyle, and Raymond Realty. Tata Steel doubled its profit during Q4 of FY25. This 1,200 crore pack was driven by the company focusing on cost cutting and higher volumes from ramped up production. But if you check its revenue, instead of going up, it actually dropped by 4% to around 52,200 crores. Why? Because steel prices have been sluggish lately. So even if you're producing more, sluggish prices can still drag down your top line. And here's the real kicker. It's making bigger plans of a massive 15,000 crore capital expenditure. For those unfamiliar with the term, capital expenditure or CapEx is the money a company spends to buy, upgrade, or maintain long-term assets like buildings, equipment, or tech. It's basically the company's way of saying, we are putting our money where our future is. It shows how much they're investing to grow, stay efficient, and keep up with the competition. And most of this money will back the company's growth in India, with around 80% going to current projects in their home ground. The rest will be used for businesses in the UK and the Netherlands. The company is also trying to balance growth along with all this. It's looking to save over 10,000 crores this year while sticking to its plan of cutting debt by $1 billion annually, all while continuing to invest in its growth. It is even planning to pump in $2.5 billion into its Singapore arm to shore up its European business and cut debt. For context, Tata Steel ended FY25 with over 82,500 crores in net debt. While they're trying to make progress, the debt is still very much in play. Still, the company expects to do better this year than the last. With a better outlook on sales, stable prices, cheaper raw materials, and cost-cutting initiatives, they're aiming to chip away at their debt, boost profits, and continue dominating the steel game. So while Tata Steel's betting on the future, is going to be a juggle of cuts, spends, and managing debt. Things change fast, especially in the stock market world. Just a few months ago, India was the underdog in Asia, with foreign investors pulling out and weak earnings hurting the markets. But now, India is the star of the show, pulling ahead of even Japan. That's according to Bank of America's latest Asia Fund Manager survey. It turns out 42% of global fund managers are going heavy on India. That's nearly half of them, and that's thanks to global shifts in supply chains and tariffs shaking things up, making India look better placed. And this is a major turnaround, especially considering that India was practically the second least favorite market in Asia back in February. That's as per the same survey, of course. So what changed? Well, Indian indices have bounced back and are doing better, while Japan is lagging behind. In fact, the Nifty 50 is now up 4% since the start of the year, but Japan's Nikkei 225 has dropped by over 4% during that time. Japan, which had been holding on to the top spot in the survey, has slipped to second place. Meanwhile, China makes a surprising comeback, shooting up to third from the very bottom in just a month. Now, with 42% of fund managers being overweight on India, Japan's not far behind at 39%. China, though it's barely on the radar, with just 6% of fund managers going heavy on it. So it looks like fund managers are all in on India's infrastructure and consumption boom. People are building, buying, and spending, and that's being tracked closely. But there's also some cautious takes as well. Another brokerage, CLSA, recently said in a note that India's reputation as a safe bet might be slipping now that the US-China trade tensions are cooling off and things are looking up in that region. So even as things have turned around for India with fund managers now all in on its growth story, it'll be interesting to see if we can keep up the momentum. And that's it from us at Bullseye this week, folks. Don't forget to hit subscribe if you have enjoyed watching this video. Hit that like button too and hit that bell icon so that you know and get notified when the next episode drops. We'll see you next Thursday.